Okay, we've got Mike Weber on my immediate left, Magnus Fyhr, Managing Director of Seaport Global. Mike is with Wells Fargo, of course. Randy Giveans, who we've just heard from, Vice President of Equity Research at Jefferies. Jonathan Chappell, that's Senior Managing Director of Evercore. Nicolay Dyvik, Head of Shipping Research at DNB Markets. Herman Hildan, Managing Director of Clarksons, Platou, and Gregory Lewis, who is not here. I'm going to start with, first of all, nearly all the questions that I was going to ask have been answered. So I'm going to, during the course of the day, so I'm going to throw a few general ones at you and then let you folks take over, and I will feed questions to you if it begins to look like you're running out of things to say. How's that? I'm going to start with this question. Anyone who wants to take a shot at it, it's a very slow, soft pitch. Do you agree that the maritime industry as a whole now is in a better position than it was in 2008, at least in some ways, to weather a new recession? Anybody want to looking back at 2008, those of you who were alive then, what do you think? Are we in better position now if something bad happens? The black swan that one of these gentlemen referred to?
Yeah.
Herman, you go.
I'm going to give it a shot. I mean, I think it's clear that today is a much better time to be in the shipping industry than 2008, knowing what happened the 10 years after 2008. So I would definitely say yes, much better today.
You can say the difference between 08 and now is that in 08 all ship values were all-time high, and now ship values are historic low. Yes, you've seen some segments recovering from the bottom, but if you go a year back, all shipping segments traded had rates below cash break even. Some today are having above, but that's just started.
But if I understood the question correctly, Clay, it says, is the industry better today to withstand a problem like a financial crisis? And then I would argue, no, it's not better, because the asset values are so low, because the LTVs are so stretched, because the balance sheets are so poor, because the stock prices are so low, because the investor interest is so much lower than it was 10 years ago. No, I don't think it's better today to withstand a financial crisis than it was in 2008. 2008 provided quite the runway, and this time you have so much more overcapacity across the entire industry than you did 10 years ago.
Let me throw a quote at you. Now, this is from a man named Daniel Arbus, who's the CEO of Zerion Investments, and he wasn't talking about shipping. He was talking about the global economy. But he said, and I quote, "Higher rates are coming, possibly heralding a tsunami of credit defaults," unquote. If that does happen, or something like that, heaven forbid, we're not talking about shipping, what would the impact be, as you see it, as analysts, on our various sectors of the shipping industry? You want to take a stab at that? Remember, nobody's going to remember what you predicted next year. Next year, you won't be held responsible.
I mean, I don't think I'm going out on a limb when I say that credit defaults are bad, and that's generally going to be bad for the space. But I would say that even within the context of some of the, even if you take kind of interest rate-driven credit defaults off the table, like we recently downgraded the container names on the premise of heightened counterparty risk from IMO. I think that generally speaking, the names that we cover typically move around based on to some degree on the counterparty risk of their larger peers and their larger customer bases. So if you see names like CMA, MSC, some of the mid-tier container lines starting to bleed even more so than they already are, I think that's going to be bad for just about any ancillary sector, any supporting sector, and that's supported over a lot of historical data, kind of correlating bond yields to equity prices. But beyond that, in terms of widespread moves in interest rates hurting shipping, I mean, it's certainly not good for things that are priced in dollars and made out of steel. And more constrained capital availability in that scenario is generally also not great for balance sheets. So I'll turn it over to somebody else if they want to swing it.
Well, Jonathan wants to say something, don't you, Jonathan? You're Dr. Doom. What do you think?
You know what?
The last panel was so sunny, I think it's time we dumped a little bit of cold water on everybody.
I'm going to take the opposite of Dr. Doom, though. I mean, I agree with Mike's premise. Obviously, rising interest rates for companies that have extensive leverage isn't the best thing in the world, but to a certain extent, maybe it does keep the hands in the pockets forcefully of ship owners. So when you do have the beginning of an upturn to a market, you don't see a rush to the yards again, and you can actually have a prolonged upturn. So maybe in a perverse way, a rising interest rate environment manages supply better throughout the course of a cycle and, like I said, elongates an upturn.
I mean, the biggest issue is going to be the deflationary impact on the dollar and the fact that all these are NAV trades. So if you're not seeing a lot of asset inflation, it's going to be tough for these names to re-rate outside of a larger multiple, which to John's point, maybe down the line, if you see a lot more capacity discipline, you could see that. But the biggest issue is going to be the deflationary impact on the dollar.
I'm looking for other comments on this. Does everybody else sort of want to hang back and not? Okay. Nobody wants to say anything more. Well, we heard quite a bit about IPOs earlier today, and as we all know, there have been a number of, shall we say, unsuccessful efforts during the past couple of months. IPOs are very important to our market here in New York, generally. What's happening? Do you think there's a chance we're going to see, as they say about the Tommy and Jimmy Dorsey, the big bands coming back? Are we going to have any more IPOs, or are they a thing of the past for the foreseeable future?
Yeah, there were some unsuccessful IPOs recently. Jefferies was not on any of those, but coincidence or not. There have been some very successful secondary offerings recently. I know Scorpio Tankers just did one 10 minutes ago. That said, for a successful IPO, you need scale. You need some kind of diversification or differentiation. You can't just have some spot cape sizes and say, hey, give us money at a premium to NAV when everyone else is trading at a discount. So there's a lot of variables that go into it. I think the biggest will be scale. You can't do a $100 million, $150 million IPO. It's got to be 300 plus.
Yeah, if I can add to that, I think the investors are a little smarter. Over the years, looking at some of these IPOs.
You mean we've learned something?
There's a lot of things that went on the market in between 2000 and 2006 that probably shouldn't have, gone public. And I think the market is a lot more selective now. So, like Randy said, you have to have a good story, and big market cap would help definitely.
Any other thoughts? I know the cocktails are already being set up.
Well, I mean, just
which I haven't brought in here.
We've gotten smarter. So, before the summer, I was a bit curious to kind of figure out what was the first time the shipping markets reached an all-time low. And Clarksons history goes back 160-something years. And the first time in the broker reports where they said that this is an all-time low was in 1884. And the three key reasons for the downturn in the market at the time that the brokers highlighted was A, too much ordering of tonnage the last 3 years. 134 years ago, so this is when steamships were out competing vessels with sails, okay? The second was reckless credit given by banks and shipyards. And the final point was irresponsible behavior by ship owners. When you think about the essence of the things we've been discussing over the last couple of years, I think, back to the point that people learn and we get smarter, I think it's evidence that, and by the way, the 1880s also ended with a real freight boom described as never seen in the shipping industry before. And I think the point is that even though the last 10 years have been a very tough part, I mean, I would argue it's been the worst and most challenging period of modern shipping history. It's a cyclical industry. It goes up and it goes down. And I think that's, we talk about, at this point in time, I think we are a year and a half into the recovery of the shipping markets. And there are a lot of people that needs to wake up to what's going on. I mean, we have LNG rates of $100,000 a day. We have tanker rates moving from $20,000 to $40,000 a day. So I think it's, without being specific about any IPOs that we have been involved in, I think the bottom line is that the owners, they had a choice. They could take the price that the market was willing to pay, and they weren't willing to take that price. So they will come back to the market at a later stage and do it at the price that they're happy with. So I think it's, whether you execute an IPO successfully or not, I think it really boils down to the price and price expectations. And yes, of course, there's going to be more IPOs in the future, no doubt about it.
Like the market's definitely still there for the right deal. But aside from even just scale, there needs to be a reason for existing, right? Or a reason why something is coming to the public markets besides just simply a kind of a me too, kind of hopping into the same trade. But it certainly seems like the market has gotten more selective, and hopefully analysts and banks have gotten better at aligning themselves with companies that they want to put to the public market. There's a line of thought around the fact that you could pitch equity to investors, and no one's putting a gun to their head making them buy that. But at the same time, that's the same logic that drug dealers use, right? So there's a responsibility that goes into that, and I think that on the whole, the quality of the deals that have been brought to the street, not completely, but for the most part, have been probably better over the last 5 years and the 5 years before that. So hopefully that continues.
Nicolay.
If you look in dry bulk and crude tankers, I have a hard time to see IPOs taking place, since you have already several market caps above $1 billion, and you have good companies. If you look in the product space, there's not that many publicly listed companies with a large market cap and a low cash break even. And in that segment, you need a low cash break even to make money. And among some of the listed peers, at their cash break even, you seldom make money. So I would much welcome something in the product space, and I think that's doable. And on the LNG market, there's so many different vehicles. You could be exposed to FSRUs, MLPs, floating liquefaction, but yes, you have flex LNG. It's now emerging with larger scale, but I think in shipping on the LNG side, probably yes.
Anyone else want to comment on that? Because I have one follow-up thing. Listening to Dr. Henderson of Shell at lunch today, for those of us who were there, talking about safety at sea, talking about the health of the seafarer, it occurred to me that that may be the beginning of the next regulatory cost that is imposed upon the ship owner and operator. It has been the case, and I haven't used the S word yet. Every other panelist discusses, we're not using the S word, okay? You know what the S word is. What is the S word? If you don't know by now, I'm not going to tell you. Every single panel has talked about it yet.
I thought we were going to say super
profits. We're not
profits.
going to use the S word. It's too late in the day for that. But what has been driving up, ultimately, the cost of shipping, and listening to Bob Burke in the last panel, he had a big grin on his face, as he often does, because I think Bob gets it. There's going to be the fact that these regulatory costs are being piled on the ship owner probably is going to be a very useful barrier to entry into the shipping industry. This may actually work towards continuing to reduce the amount of tonnage out there. I don't know, but I'm just going to ask you, do you agree with what I just said, that regulation, IMO, and I'm not just talking about 2020, I'm talking about all the regulatory burdens that are hitting the industry and may come up, because the bureaucrats will think of more, in the next couple of years. Global warming is not going to disappear just because the U.S. government says it's disappeared. What do you think is going to happen what's the effect of that going to be on the present tonnage overhang? Anybody want to comment on that? Because that, I think, is one of the major factors that will influence the prosperity of the industry. We can cut back on the number of ships that are out there. It's going to be better for those of us who are still in the business. True or false? Do you agree with me? Do you disagree with me?
I'll say
I'm throwing
false.
this out to you. This is not a received truth, Jonathan. It's just something I want to hear you.
Well, I don't think it's an easy question to answer, honestly, but I think Herman's 1884 recital made a lot of sense as it relates to this. I mean, if we're talking about operating costs going up 10 or 20% in a bull market, that's not a barrier to entry. If the shipyards have the capacity, if the owners are making good returns, if the banks are lending at good rates, if the equity markets are open, an extra $3,000 a day isn't going to keep the new entrant out. So I think it's false. I mean, unless it becomes such a punitive legal environment where the fines are huge or the liabilities become, detrimental, no, I don't think so. I think it's false.
Anyone else want to comment on that? Everybody's very quiet. I think we're going to end early, He goes, I'm going to ask one or two more questions, then I'm going to ask the audience if you have any questions. And if you don't, we're going to go next door. True or false? You think syndicated deals will dominate the market in the next 5 years or so? Yes or no? We've heard a lot about that today, but I'd like to hear your opinion. So we can start with you, Michael.
I'd rather talk about IMO.
Okay.
I don't know, probably.
Herman?
I don't have a strong opinion about syndicated deals, to be honest.
Anybody else?
I'm an equity analyst. I can give you my top pick.
So just to jump back, and I appreciate John swinging at that question. In terms of whether regulation keeps the fleet from growing, if anything, it seems like it's presenting an opportunity or a degree of inefficiency, which typically attracts capital. So I don't know. I think I tend to agree with John. But in terms of what we're looking at for the next couple of years, I think 2020 is going to be a pretty pivotal year, not just from IMO, but also the new accounting regulations, the changes in lease accounting, which are going to change the behavior of a lot of public leasing companies, or lessors rather, or both. I think across anything with long-term charters or tenor, the counterparties behind those are going to have to recognize that as debt, and I think over time it's going to change a lot of the operating models for a number of companies. So yeah, I tend to think of it as an opportunity. I mean, we've obviously seen people try to raise capital on the back of it, so I think I would love for it to be a barrier to entry, but it simply doesn't seem like that's the case. But I think we'll look back on 2020 after a few years as being pretty pivotal for the space in general, and generally pretty positive. I think certainly the environmental regulations seem like at least a step in the right direction, if not maybe not the right step, but it's at least a step in the right direction. And certainly seems like it's going to create some inefficiency to benefit the equities. But
yeah, I agree with you, and I think we talk about regulatory changes as something that's new. I mean, single hull, double hull, sailing ships to steam ships. I mean, it's happened from day one. It's the evolution of the industry, and I think bottom line is it's at the end of the day a good thing that should be looked upon as an opportunity rather than a threat. And obviously in this environment that we've been over the last couple of years, making new investments is not really something that's very something you look upon with optimism, given the capital constraint that you have on the shipping industry. But regulatory change will happen in the future as it has in the past. And the bottom line, I mean, IMO 2020, it's a good thing for the world health. So I think, yeah, it will continue. I don't think it's going to derail or change or
You're not worried
anything
about
different. No.
Disruption is good, since owners tend to order too much, and if you have regulatory changes every now and then, you have a chance to take away that overhang. And yes, why you've seen a lot of VLCC scrapping this year? Is it regulations coming, or is it since the market's been poor? I think it's probably a combination. And let's see how many ships will be scrapped when VL rates now are $40,000 a day, and look towards 2019 and 2020. I think it's good. Many talk about lots of scrapping potential on the tanker side, but I think it's good to remember and probably give some credit to Bob Burke, who bets on the older ships once again, that the ship that obtained the highest rate during the single hull phase out was a single hull ship, since that was the last ship standing unfixed that has obtained the highest rate.
Mm-hmm.
One good thing with the new regulations, we've seen a lot of the dry bulk owners that are one of the few segments that are making cash now. They're actually spending their excess cash on scrubbers rather than going to the shipyards and ordering new ships.
Okay, I have another question, and then I think we'll turn it over to the audience very briefly. Let's pretend that I just inherited a lot of money from George Soros, my uncle, my rich uncle, and I want to invest in the shipping industry. You think I should sink my money into Lois Zabraki's company back there? Answer yes or no.
Yes, absolutely.
Let's go down from the yes?
What was the question? I didn't hear the question.
Company.
Well, Lois is sitting right back there. She's the CEO of a major shipping company, which I hold in very high regard. And I've inherited all this money from my, we won't say he's deceased, but let's pretend, George Soros, my wealthy uncle, and my extremely wealthy uncle. And I want to sink it into a shipping company. Not to the point where I take it over, you understand, but would you recommend that I invest heavily in Lois's company?
Yeah. Definitely. I think, that's one of the companies that we think look attractive on valuation, trading at a pretty good discount to NAV, and one of the few that actually are trading at pretty good discount. So yeah, we would buy an INSW.
I think the answer is going to be a 100% yes from the panel. So instead of kind of going through that, it's instead talk about what's good about Lois's company, right? I mean, she does have a few older ships that, as Nicolay just said, that's where you get the most bang for the buck when values. I would say the tanker market today is where dry bulk was in 2016, and what you saw was the heavy discount on second-hand values went straight back to parity. So the ships that some might say that she should scrap today is probably where she's going to make the most money. The other thing which is good about international COAs is obviously the low cash break even. Instead of making up your mind that I think I want to have a 100% VLCC company, there you get a bit exposure to the different types of the tanker market, both crude and product. So I'm not sure if anyone wants to add any other positives or negatives for that matter. I guess this is the time to have the conversation, right?
Jonathan, do you agree?
So let's take the two questions separately. I don't cover Lois's company, so I can't opine on that officially, but I love Lois and Jeff, so sure, we'll throw some money your way.
Good.
I also like Herman, but what I hate is the tanker industry today is the dry bulk industry of 2016. I really disagree with that. The order book for VLCCs is much larger today than it was for dry bulk in 2016. Dry bulk 2016 was coming off 2 years of artificially deflated demand that then immediately became an inflationary demand environment, which was beneficial, and I don't see that with tankers. In fact, most agencies are lowering their demand forecast for next year. So, listen, I get the Dr. Doom moniker for a reason, and I'm not negative on everything, but crude tankers today I do not think are dry bulk 2016, and therefore I think there's better uses for your George Soros inheritance, Clay.
Crude tankers today is what LPG was in 14, 15. Huge benefit of US exports on ton mile. You see what's happened on the LNG side. You saw what happened on the LPG side. You haven't seen it on tankers yet since you've had years of high delivery growth, way over capacity, inventory draw as opposed to shipping production. But now you have zero fleet growth most likely this year, Iranian floating storage, Saudi Arabia and Russia ramping up for shortfall of Iran, and the US ton mile. The average sailing distance out of the US is 70% higher, last observation, relative to Middle East. So you tie up 70% more tankers out of the US. That's going to have a huge impact on tankers. So tankers is LPG replay, 14, 15.
I'll add some love to INSW. So we initiated on them about a week ago as our top pick in the space. Shares trading at a 20% discount to NAV, industry-leading balance sheet. They have some FSO joint ventures, LNG joint ventures. Probably the best diversified tanker company with some products, with some crude, with some scrubbers now. So INSW for sure. $30 price target.
Michael.
So, yeah, I don't know whether I don't like to comp the tanker market to the dry bulk market of 16 or the car carrier market of 1977 or any of that stuff, but I like to work backwards on this sort of stuff, and I do think I generally think tankers are superior equities to dry, simply because it's easier for me to see an institutional investor taking you out of a mid-cycle thesis. They're more liquid. They're going into energy books where people already understand the dynamics. So if you look at the tanker market, especially the next couple of years, they're the only sector that we cover that are not price takers when it comes to IMO on a net basis. And I would argue that for crude over product, in the sense that the equivalent, with MRs at 35, 36 million, the equivalent V price is 104, right? So you're stepping in at a much steeper discount to crude names today. And then to answer your question on Lois's company, I don't cover INSW, but if I'm working backwards, I think there are better relative ways to get that exposure simply because I can find more liquidity in some of the bigger names. Eventually, I do think they will get there, but they would be in a basket, but if I'm picking one name to own heading into this, it would be one of the names under my coverage. That's probably a bit
And what are they, if I may ask?
Sorry, Lois. Is that?
Cargill? What'd you say?
We're long, we upgraded the names in June, so Euronav, Frontline, DHT are the three primary beta trades. Frontline's more expensive than the other two, but it's hard for me to see the tanker trade working without Frontline working too. So I think they're in the same group. But Euronav has traditionally been our favorite tanker name. I would probably bet down the line that Euronav is probably everybody's favorite or in their top two. I don't want to speak for everybody, but yeah. So that and then the 1977 car carrier market.
Thank you.
But since we have some more time, I mean, this is your chance to talk about how the tanker market is, for all of shipping, IMO 2020 is, obviously positive because of the potential supply disruption, but obviously the tanker market has an addition to that one on the demand side.
Yeah.
So do you want to elaborate on that?
It's hard to come up with ways to destroy 3.5 million barrels of high sulfur fuel oil without using more crude. Right? So if it's not all destroyed on day one, and we put math together to basically points to the fact that we're already systemically long 4 or 5 VLCCs of floating storage as we stand today, which should kick in March of 2020. But there are just very few permutations when Goldman had a good piece out. I just saw Justine kind of working backwards. It's probably like an elegant solution to kind of back into how many scrubbers you need in different permutations to balance the market.
You use the S word.
And they're all big numbers, and they all assume a ton of efficiency that's not going to be there. So if you start stripping some of that efficiency out, it's going to be really messy, and it's usually really good for crude tankers. So I would. The first comp that comes to my mind is a single hull phase out. Everyone saw that coming, but in terms of an exogenous shock to exogenous, I guess it's a demand shock, but exogenous shock to the utilization curve, that's the first thing that comes to my mind.
Yes. Agree. Nicolay, you agree?
I think I
need advice. I got all this money burning a hole in my
We
pocket.
upgraded tankers in March of this year. Then rates were 4, now they're 40, and let's see where they are in 2020.
Oh, so you're going to wait and see?
No, I'm not going to wait and see. We placed our bet 6 months ago, and it's panning out.
Well, did you understand what he just said? I didn't understand what you just said. So
He just
what
said
was the bet that you
just
placed
said they
6
were
months
early.
ago?
Bet that I think
There's an echo in this room, so I need clarification.
On the tankers.
Yes.
Yeah.
Older tankers.
I think that the first phase, when we upgraded in March, we argued that you should buy the most levered companies since it wasn't a cash flow play, it was an asset appreciation play. Now I think a bit different. Now you've seen values going from 84 to the low 90s, and we think that Euronav has probably got a bit of a challenging first months post the IPO, since there is a few legs of previously bankrupt companies into the shareholder list. So there's probably a bit of overhang. It trades at 10% discount to NAV, and Frontline trades at 70% premium to NAV. And I think that people have been, I think if you look at the coverage universe, there's a bit 50% being positive and 50% being negative. And buying into a $2 billion market cap company at 10% discount to NAV, I think that's probably the best buy today.
That sounds like pretty good advice to me. What do you think, Jonathan? Do you agree?
I think I've already made my views clear that I'm not as bullish as my peers here on tankers. But if there is a way to play it, Euronav is our top pick on the crude side too. And it's because you get the operational leverage and the earnings upside to a recovery, but you also have the downside protection from a much better balance sheet in a downturn. And the valuation, as Nicolay said. Frontline can go from 3 to 6. It can go from 6 to 3 just as fast. So I'd rather be in a steady state in the early innings.
Thank you, Jonathan. Randy, do you? I know you already made your views known, also, but do you still have you changed your mind after hearing this?
Nope. International Seaways first, Euronav second.
Ooh. Fantastic. Now that leaves us with Magnus.
If I change my view, or?
Pardon? I can't hear you. There's too many echoes down here.
No.
Either that or it's my age.
We actually like Euronav. I agree with Euronav as our top pick. And we like the crude segment for the reasons stated. I mean, we think the crude exports, the OPEC exports, and potential for floating storage should be very positive for the market. And keep in mind, to invest in the shipping sector, you sort of have to be a contrarian to make the big returns. And I think the market is still not 100% sure that we're going to see a recovery in the crude market next year. So that's why you would buy tankers today.
Okay, well, thank you very much. Now, we have time for one or two questions from members of the audience. I see some very knowledgeable members of the audience, but they don't seem to want to ask questions. Dagfinn, do you have a question?
There's one over here, on the left.
Who's got a hand up? We need a microphone for this gentleman here.
We'll repeat your question.
Why don't you repeat the question?
It's interesting that you mentioned NPV. You mean NAV, I guess.
Sorry,
net asset.
Because I think the NPV is much higher than the NAV. That's my point.
So the question is, why do you think so many of shipping companies trade under net present value of the ships? Is it, as John Fredericks normally says, because of bad management, or is it some other reason?
I think management plays a role. Also liquidity, market cap. You know, we like Stealth Gas, for example, but with their market cap of, I don't know, $250 million, it's not much liquidity. It's hard to get large investors in the name, although they're trading at a 50% discount to NAV. Now, is some of that a management discount? I'll let you be the judge, but I think a lot of it is liquidity, market cap discounts as well.
I think the market or the shipping sector has a very poor track record of generating positive returns over a long period of time. So everybody's trying to evolve around the NAV valuation. And, you know, you can look at the NAV in different ways, but, you know, maybe the market is right. So if stock is trading at a 20% discount to NAV, maybe that's where NAV should be.
I think what's a bit kind of unique about the shipping industry when you compare to other industries is the fact that, for example, Coca-Cola or these companies, you can create a lot of value by the actions that management takes. But in the shipping industry, the value creation to a big extent is actually external. And that makes the management of shipping companies more, call it steward of capital, rather than creating value from within. So to say that the discount on the underlying values is driven by poor decision making within the shipping company, I think is a bit of a stretch. I think it's more that the capital market is, I mean, the shipbrokers are lagging. If you look at the price to NAV throughout the cycle, when values are increasing, you see that the equities are being priced at a premium to NAV. And when they're falling, they're being priced at a discount. And I think at this point in time, we are a year and a half into the recovery. If you look on the Clarksons new building index and the second-hand price index for all values in shipping, they bottomed out in December 2015. And you know, 2018 run rate is the second lowest number of number of ships being ordered since 1996. The lowest was 2016, and the third lowest is 2017. And despite, I'm talking about number of ships, not in relative or anything like that, despite record low contracting activity, the Newcastlemax new building price have added $500,000 on average per month the last 12 months. The VLCC have added, what, $8 million year to date or something. So I think it's what we see is that if you look over the long period of time, there are long inflationary and deflationary cycles. What Martin Stopford talks about, the long cycles in maritime economics. And we believe that we've bottomed out on the 10-year deflationary cycle. And obviously, I think it takes time before the market is willing to buy into that. You want to see the evidence, but we're at an inflection point. So
I think you could add that there is also distinction between companies having a major shareholder where they invite other shareholders to co-invest and share the upside, as opposed to have shareholders on one side and management on another side with little skin in the equity.
You need context behind it. So the equities are a forward-looking mechanism. So trading above or below your NAV just tells you what direction the market thinks assets are going. So that's why we need a trough and a mid-cycle NAV, and then kind of plotting current NAV against that. But if you look at it over the course of a cycle, if someone's getting a discount to NAV over the course of the cycle, that's going to be the market saying that management destroys value. And I think that when you look at the bulk of this space and the bulk of the public history, there are an awful lot of people that came before you that destroyed an awful lot of value. So I think you're kidding yourself if you think it's not an uphill battle to convince investors that you need a premium to NAV when there's that much crap history behind you. So some people can do it, like asset agnostic asset managers like Fredrickson with a big history of return of outsized returns get a systemic premium to NAV. There are some others that do as well, but you need context, and then you're fighting an uphill battle because of the sins from 2005 to today.
So who's still optimistic?
optimistic.
Optimistic.
Yeah, 100%.
1, 2, 3, 4. Come on, Jonathan? Jonathan?
I mean, I generally am. I'm positive on LNG. I'm positive on dry bulk. You know, it just, let's not get too optimistic. We had to write this little paragraph for the booklet that Nicholas is passing out, and my last sentence was, I'm finally optimistic about the industry in general, but let's not get too excited, because inevitably the barriers to entry are still really low, and the cycles will end, and they'll end in tears. And I think Mike had a really great point there, and I wanted to bring it up myself, but not maybe be as inflammatory. But here we go. I have a minute, 30 seconds left, so let's just end on a good note. The group in general, and it doesn't matter whether it's LNG, dry bulk, product tankers, crude tankers, almost every stock we cover trades at a discount to NAV right now. And I think a lot of that has to do with the cycles. There's 7 years of downturns, 2 years of upturns. No one can time it really well. You don't want to be early because that's painful. Mm-hmm. If you're too late, it's just, you're going to be the last one holding the bag. And the value destruction across the industry has been noteworthy. And the only people who've made money in this industry over the last 10 years, since the financial crisis, have been the ship owners. We haven't made any. The investors certainly haven't made any. I mean, it's amazing that we're still all here. That's it is. So I'm very optimistic about the next 2 years, but beyond that, it's hard to see how the game changes.
It's put in a much nicer way.
Maybe we can ask them.
We've been nice for 10 to 15 years. It's not working. So maybe just calling a spade a spade. There's been a lot of value destruction. There's no hiding that. There's no way around that. Like, I don't know who we're kidding by saying there hasn't been.
So can we ask maybe each one of them, which are your sector picks? I mean, clearly a number of
I tried to do that already.
Yeah, a number of them are bullish on tankers, but is there any other sector that you're bullish on? Or?
We're long crude tankers and LNG, so short containers.
Pick one sector. I would pick shipping. I think all of it looks fantastic. So.
So that goes back to the George Procopio statement that Posidonia buy everything that close.
Yeah, exactly. I mean, if there's one guy you should listen to, it's definitely him. So buy everything.
The cycles in shipping are becoming shorter and shorter, and the beauty about shipping, it's what goes up comes down, and what goes down comes up, and now we're at the low point. And LNG, so it's, you know, you will always talk about long-term returns in shipping. You shouldn't be invested over a long time. You should cherry pick your moments, and we think LNG is probably the sweet spot to be in now.
Can I arrest you a bit there, or not you, but there's one thing I think is important. If you read Martin Stopford's Maritime Economics, where he talks about the
He's
20.
a colleague of yours, or?
Yeah, he's a colleague of mine. But he talks about the 22 cycles, the last 270 years, and the median cycle is actually 10.4 years from peak to peak.
Well, there you are.
So this cycle, people say the cycles are getting shorter. It's actually quite the opposite. We were still waiting to get to the peak. It's 10 years ago. So
it's available at www.clarksons.net.
Let me
And
say
they're not
that the
getting- they're not getting
upturns will
longer.
be shorter since China's built out the shipyard capacity. They pay for the commodity, which is freight and commodity. Hence, if they destroy or build out the shipping industry, their imported goods will be low cost. So that's why the up cycles will be shorter.
Okay, time will show.
We've already heard from you, Jonathan. So,
Enough, plenty enough.
Like dry bulk for sure over the next 4 months, but longer term, crude tankers and LNG carriers.
Yeah, we're long most of the sectors. The dry bulk is probably furthest ahead. I'd say most stocks are not reflecting the positive cash flow that we're seeing generated. So we'll be a little careful with dry bulk once we move further into the cycle. But I think crude tankers and LNG is just coming off the bottom, and I think you can get a good runway there. So we like both crude and LNG.
okay, can I offer a vote of thanks to, first of all, the panel? Can you please, let's give them a round of applause for going on in our room. I'm going out and I'm buying one particular stock. The lady in the back there. And
You must be a shareholder already.
yeah, I think I am, yeah. And I already am. I'm buying more. And I want to thank Nick Bornozes and Annie and Olga and all the other people who make Capital Link really work and who really put this whole program together. You make it easy for all of us. Thank you very, very much for everything you do.